Imagine waking up, checking your investment portfolio, and seeing technology stocks suddenly falling while oil companies surge. What happened? Was it bad earnings, a recession, or something even bigger? Today's market wasn't driven by just one headline. Instead, it was the result of three powerful forces colliding at the same time. First, rising geopolitical tensions threatened one of the world's most important oil routes. Second, investors started questioning whether the AI boom is moving too fast for companies to justify the enormous amount they're spending. And third, the market is now waiting for one of the most important inflation reports of the year, a report that could influence what the Federal Reserve does next with interest rates. In today's video, we'll break everything down in simple terms, explain why the market reacted the way it did, and discuss what investors should keep an eye on in the days ahead. Let's dive in.
Chapter 1. A tough day for the markets.
Today's trading session reminded investors that markets can change direction very quickly. The biggest losses were seen in technology stocks, while energy companies benefited from higher oil prices. This type of market movement is known as a risk-off environment. When uncertainty suddenly increases, investors often sell riskier assets like high-growth technology companies and move toward assets that are considered more defensive. That doesn't necessarily mean investors believe the economy is collapsing. Instead, it means they are becoming more cautious while they wait for more information. Today's caution came from several major developments happening all at once.
Chapter 2. Why the Middle East matters to Wall Street.
At first glance, it may seem strange that events happening thousands of miles away can cause American stocks to fall. But global markets are deeply connected. One of the most important locations in the global energy system is the Strait of Hormuz. Every day, a significant share of the world's oil supply travels through this narrow shipping route. Whenever tensions rise in the region, investors immediately begin asking one question: what happens if oil supplies are disrupted? Even the possibility of interruptions can push oil prices higher. Markets don't wait for shortages to happen, they react to expectations. That's exactly what happened today. As concerns increased, oil prices jumped sharply.
For energy companies, higher oil prices often mean stronger revenues. But for the rest of the economy, expensive oil creates new challenges. Transportation becomes more expensive, manufacturing costs increase, airlines pay more for fuel, shipping companies face higher expenses. Eventually, businesses may pass those costs on to consumers through higher prices. That's where inflation enters the conversation.
Chapter 3. Why oil and inflation are connected.
Inflation simply means prices are rising over time. Energy plays a surprisingly important role in inflation because almost every product depends on transportation. Think about it. Food travels by truck. Online purchases are delivered by vans. Factories rely on electricity and fuel. When energy becomes more expensive, businesses often have little choice but to increase prices. This is one reason investors pay close attention whenever oil experiences a sudden spike. If inflation begins rising again, central banks may need to keep interest rates higher for longer, and that's exactly what markets are worried about this week.
Chapter 4. The Federal Reserve's next move.
The Federal Reserve has one of the most difficult jobs in the economy. Its goal is to keep inflation under control while supporting employment and economic growth. If inflation remains too high, the Fed may decide not to lower interest rates. In some situations, officials may even consider raising them again. Why does that matter for investors? Because higher interest rates make borrowing more expensive. Businesses pay more to finance expansion. Consumers pay higher mortgage and loan payments. Companies become more careful about spending. Growth can slow. Markets know this. That's why every important inflation report receives enormous attention. Investors aren't just watching today's numbers, they're trying to predict tomorrow's decisions.
Chapter 5. The AI boom faces a reality check.
The second major story affecting markets today wasn't geopolitical, it was artificial intelligence. Over the past 2 years, the world's largest technology companies have spent hundreds of billions of dollars building AI infrastructure. Massive data centers, powerful graphics processors, specialized memory chips, cloud computing facilities. The belief has been simple: spend now, profit later. But investors are beginning to ask an important question: when exactly will all this spending begin generating meaningful returns? Building AI infrastructure is incredibly expensive. If companies slow down their investments, or if future profits take longer than expected, investors may start questioning whether today's valuations are justified. That's why semiconductor companies experienced significant selling pressure. When expectations are extremely high, even small doubts can cause large price swings.
Chapter 6. Why high expectations can become a problem.
One lesson every investor eventually learns is that great companies can still experience falling stock prices. Why? Because markets don't only evaluate today's performance, they price in future expectations. Imagine a company expected to earn $10 billion next year. If investors suddenly believe it may earn only $9 billion instead, the stock can fall sharply, even though the business is still growing. That's what often happens with fast-growing technology companies. High expectations create very little room for disappointment. Markets aren't asking whether AI has a future. Most investors believe it does. The debate is about timing. How long will it take before these enormous investments produce sustainable profits?
Chapter 7. Earnings season is about to begin.
Another major event is just around the corner: corporate earnings season. Over the next several weeks, investors will hear directly from some of the world's largest companies. Bank earnings usually arrive first. Why are banks so important? Because they provide a snapshot of the broader economy. They can reveal whether consumers are borrowing more or less, whether businesses are investing, whether loan defaults are increasing, whether confidence remains strong. Markets don't just react to the numbers. They react to management's outlook for the future. Sometimes a company reports excellent results, but lowers its guidance. The stock still falls. That's because markets care more about tomorrow than yesterday.
Chapter 8. Putting everything together.
Let's connect the dots. Geopolitical tensions pushed oil prices higher. Higher oil prices increased inflation concerns. Inflation worries raised expectations that interest rates could stay elevated. Higher interest rates placed pressure on expensive technology stocks. At the same time, investors questioned whether AI spending is producing returns quickly enough. Add an important inflation report and earnings season just days away, and suddenly investors had plenty of reasons to become cautious. This is why markets often experience sharp swings, even when no single event tells the whole story. It's usually several stories interacting at once.
Chapter 9. What long-term investors should remember.
Days like today can feel uncomfortable. Red numbers grab attention. Financial headlines become dramatic. Social media often amplifies fear. But history reminds us that periods of uncertainty are a normal part of investing. Every major technological revolution, from railroads to electricity, from the internet to smartphones, experienced periods of excitement, corrections, and renewed growth. Artificial intelligence may follow a similar path. Short-term volatility doesn't necessarily change long-term trends. For long-term investors, days like these can serve as opportunities to review portfolios, rebalance risk, and focus on quality rather than emotion. That doesn't mean ignoring risks. It means making decisions based on careful analysis instead of panic. Today's market decline wasn't caused by one single headline. It reflected the combined impact of geopolitical uncertainty, rising energy prices, growing questions about AI investment spending, and anticipation of critical inflation data. Over the coming days, investors will be watching inflation reports, Federal Reserve commentary, and corporate earnings for clues about where markets may head next. Whether you're an active trader or a long-term investor, understanding why markets move is just as important as knowing that they moved. Because informed investors don't simply react to headlines. They understand the forces driving them. If you enjoyed this breakdown and want clear, data-driven explanations of the biggest stories shaping global markets, make sure to subscribe to Finify. Thank you for watching, and we'll see you in the next market update.